Hi again, Doug Andrew here. I'm going to address in this episode what are TEFRA and DEFRA tax citations. When you understand this, this will be a game changer on being able to accumulate your money tax-free, access it tax-free, and of course when you finally pass away it blossoms and transfers tax-free. The key here is to understand the sort of hoops we have to jump through in order to make sure that we can do that. And so I'm going to go into an explanation of how TEFRA and DEFRA came about. They're acronyms. It stands for the Tax Equity Fiscal Responsibility Act of 1982 and also the Deficit Reduction Act of 1984. So here we go. So back in 1980, when E.F. Hutton, the brainchild behind max-funded insurance contracts, came out with the concept of, hey, instead of having the most amount of insurance you might want for the least premium, let's flip that. Let's have the least amount of insurance the IRS will let us get away with and put in the most premium. So this turns into a living benefit, a cash cow, as fast as the IRS will allow. So hence TEFRA, DEFRA, and TAMRA came about because the IRS came around snooping, what are you doing? And so they actually challenged E.F. Hutton because there was this massive exodus of money leaving the banks and the brokerage firms into max-funded insurance because they paid higher interest. They were tax-free. They blossomed when you died, and so they had a lot of benefits that many of the other places people put their money did not have. And so as the money began to go, first of all, the IRS came in and said, hey, what are you doing? Now, they were saying that to E.F. Hutton and the clients that they were doing this for. And they actually went to court because, see, E.F. Hutton said, if we take the least amount of insurance and put in the most premium, people were paying like $500,000 for a dinky amount of life insurance, and they would say, who does that? And they would, E.F. Hutton would say, our clients do, because they were using it primarily for the living benefits under Sections 72E and 7702, which I explain in other episodes. Well, they went to court. E.F. Hutton won. They weren't doing anything wrong. But then the IRS went to Congress and said, you know what, we think that they are abusing these sections of the code which allow for tax-free accumulation and access in insurance contracts. So they decided to define or redefine what tax-free life insurance is under these sections of the code. And so in 1982, under part of the Tax Equity Fiscal Responsibility Act, which spells the acronym TEFRA, they made their first attempt. Well, they didn't know quite what they were doing. How unusual is that? The IRS doesn't even know what they're doing. And so 2 years later, they had to sort of redefine it again under the Deficit Reduction Act, and that's called DEFRA. And so this became the TEFRA-DEFRA tax citation, or corridor. Now what this means is basically this. I would use the metaphor of a bucket. So if I had a client, or if I wanted to do this myself, I want to establish an insurance contract, a bucket, a repository, to put my money primarily for living benefits, but I also had to justify a death benefit. I still had to qualify for insurance and have reason and justification for the amount of insurance I was applying for. You just can't go out and insure yourself for billions of dollars. You have to prove that somebody would suffer an economic loss by virtue of your death. Otherwise, we have crazies out there that tie bombs around them and blow themselves up, and they would leave behind millions and billions of life insurance to their cult. And so you have to qualify. You have to have a certain amount of income or net worth to have so much insurance. When you set up an insurance contract for the purpose of living benefits, you're trying to have the least amount of insurance. So over here, this is the minimum death benefit required under TEFRA and DEFRA, as I'm going to explain. And then you're wanting to put in the amount of money that you choose to. So I call it like the backdoor approach. Instead of saying how much life insurance do you want or need, sometimes I say, well, wait a minute, how much money do you want to sock away and be grandfathered to grow tax-free be able to access your growth tax-free, and when you die it blossoms and transfers tax-free under sections 72E, 7702, and 101A. And so TEFRA and DEFRA dictated the minimum amount of insurance. Now, let's say I wanted to reposition $500,000. There's nothing magic about this, but I like to use a consistent example. If you wanted to be grandfathered to put in $500,000, you're not obligated to put that in, but it would behoove you to do so. This is the amount that you're allowed to put in as $500,000. Now, there's no limit to what this can grow to with interest and dividends or whatever. There's only a limit to how much you can put in. So that's $500,000. All of the compound interest that you earn on that $500,000 is tax-free under Section 72E. But when they went to Congress, they said, you know what, you need to have a commensurate amount of life insurance sort of coming along for the ride so that this does not move over to taxable investment section of the code. It stays tax-free. And so this is where TEFRA, DEFRA, and TAMRA came into play. Now, TAMRA is the Technical and Miscellaneous Revenue Act of 1988, and that's where you have to spread out the funding over a minimum of 5 years if it's universal life. If it's whole life, it's usually 7 years. It's called the 7-pay test. That's one of the reasons why I like universal life. It's more flexible, and I can fund it in 5 years instead of taking 7 years, and it usually outperforms whole life by about 2 percentage points. So I prefer the universal life, which is the brainchild of E.F. Hutton, that in order to be allowed to put in, let's say, $500,000, you had to have a certain amount of insurance coming along for the ride, so to speak. Now, the neat thing about TEFRA and DEFRA is it gave parity. So let me explain what parity means. So let's start out by saying what's disparity. That's inequality. So parity was designed to give sort of an equal opportunity, realizing that some people were young, some people were older, some people were really old, and if their objective primarily was for living benefits, because it's called life insurance, they wanted to make sure it was sort of fair. And so it didn't matter if you were a 22-year-old athletic marathon running female, or a 67-year-old geezer like me, or an 80-year-old. I think of a friend of our family who was 80 when he came to us, and he had 3 blocked arteries that were cleaned up with angioplasty. He had adult onset diabetes and a prostate cancer episode. He had 6 sisters and 3 brothers predecease him, and yet we were still able to get him an insurance contract because he had a better lifestyle than his siblings. He doesn't use tobacco or alcohol and so forth. The key with TEFRA and DEFRA is the cost of the insurance, or rather, the amount of insurance required under TEFRA and DEFRA tax citations goes down as you get older, which means if I were 22 years old and I wanted to be grandfathered to put in $500,000 into my bucket, my insurance contract, I might be required to have $5 million of life insurance. Now that $5 million of life insurance is only draining out a small percent of the cost, or the cost of that is usually only 1 percentage point. If I'm earning 11%, let's say, I'm netting 10. If I'm earning 8, I'm netting 7. If I'm earning 15, I'm netting 14. But the cost of the insurance, which is like this spigot on the bucket, has to be there under TEFRA and DEFRA. The point is, the parity said, if I'm 67 years old and I want to be grandfathered to put in $500,000, I only need $1,250,000 of insurance. That insurance costs no more than the $5 million for the 22-year-old. And so if I'm 80, maybe the insurance required might be $850,000 or $900,000, because you're doing it so that the $500,000 you're putting in will have the highest net internal rate of return, so that if you're earning 11 like I did back in 1980 to 1990, I'm netting 10. What does that mean? It means the 22-year-old, if a 22-year-old put in $500,000, can earn a net of 10, and the 67-year-old and the 80-year-old, because the amount of insurance required under TEFRA and DEFRA goes down as you get older, so that everybody can have the same net internal rate of return. See, the myth is, as you get older, insurance is more expensive. If you structure it correctly here, the insurance can actually get cheaper as you get older. Have you ever seen an insurance policy that gets cheaper as you get older? Then you haven't seen one designed correctly under TEFRA, DEFRA guidelines. So let me show you how this all comes together. With TEFRA and DEFRA, I can then design my insurance contract to have the best internal rate of return so that the cost of the insurance, the spigot on this bucket, is draining out no more than about 1 percentage points at the end of the day, which is actually watering a nice little money tree here that's going to blossom when you die. Again, we don't object to insurance benefits, we object to paying for it. This 1%, when you think about it, it would be otherwise payable tax if I put my money in a tax-deferred IRA or 401k, maybe in the market, because I might have to earn 15% to then pay tax and only net 10 or 9. Here I only have to earn 11 to net 10 because the 1% is not tax. It is the cost of the insurance that is required under TEFRA and DEFRA, but because of parity, I can get the same rate of return. An 80-year-old can get the same rate of return by squeezing down the death benefit. TAMRA says that we have to spread out the funding over 5 years in order to access your money tax-free. I explained that in another episode. The point I want you to remember is that if we comply with TEFRA, DEFRA, and TAMRA guidelines, then the money we take out is not deemed earned, passive, or portfolio income, which are the only 3 types of income we pay income tax on. I have clients who start taking out 50 or 100,000. One client takes out 800,000 a year, and it's not deemed earned, passive, or portfolio income. There's nowhere on a tax return to put it. It's tax-free. It is that cut and dried because they complied with TEFRA, DEFRA, and TAMRA guidelines, which requires a professional to help you understand how to do this correctly. So again, instead of sitting there with an IRA or 401k, hey, let's just enjoy the seed without paying tax and then pay tax on the harvest. I would rather pay tax on the seed and enjoy the harvest without tax. But I would rather have a place where I can harvest the money tax-free, and when I ultimately pass away, it blossoms and transfers tax-free. So are you beginning to get it? In other words, I like to use this metaphor. Don't focus on what it is. Some people say, oh, well, I don't need any more life insurance. Okay, what does that have to do with it? Make me the beneficiary then. In other words, I'm using it, I focus on what it does. When I ask an audience, let's say with women in the audience, what are some uses for baking soda? And some say, oh, well, it can be used in the bathtub to soak. It can take the odor out of the refrigerator, and it can take the pop out of a pot of beans. And then somebody finally goes, oh, it's good for baking. Yeah, life insurance is good for life, even better than for the death benefit. So if this is resonating with you, I would encourage you to watch this episode so you can see how this all comes together and the dots get connected. And then you'll have an opportunity to receive a copy of one of my books for free if you like to really take a deep dive into educating yourself.